Hi, I want to just stop in here real quick and just show you how I look up stocks, their prices, balance sheet and income statement information, and how I calculate annualized returns for stock. Okay, so the first thing you could do is you can look into Google Finance. You can type in ticker symbols. You could look into, let's see what else. You can look into Yahoo Finance. You can type in ticker symbols below here. As we all found out, you can look at their financials. I think Yahoo Finance has the easiest to access income statement and balance sheet information. MSN is another great place to look up information about individual stocks, cryptocurrencies, investing in general. If I go under markets, I can type in a ticker symbol here. So the ticker symbol is the abbreviated name for the company. Apple, their ticker symbol is, not that much shorter than their actual name. But for some other companies, the ticker symbol is just sort of easy, like Microsoft is really easy to access. Okay, so that would be how I would access price information about stocks. Let's see. So we've got MSN, Yahoo, and Google. If I go into Google and I want to maybe look up Disney. So if I look up Disney, I can look at the chart over time. I can get some basic information. Who are they, suggested to compare to? Or, I mean, some of these aren't suggestions that make any sense in their industry, but there's news, their website, and that would be a good place for me to start when looking at the stock price. Also, if you're interested, in Google, you can create portfolios of stocks or currencies or ETFs and indexes and mutual funds. I created one just hypothetically that you can take a look at. So Kristen's stock portfolio, I just created it today, and I just put random things in it. Like I put a share of Tesla, I put 2 shares of Meta, Facebook, not doing so well. I put not a lot of these are doing well right now. I put in a little bit of I put in a euro, I put in some Bitcoin, and then I also put in these mutual funds. So what is a mutual fund? A mutual fund is a commingled vehicle of um, basically money that people have given to an asset management firm, and the asset management firm manages it on your behalf. It's custodied not at the asset management firm, it's custodied at a bank somewhere. And the asset management firm trades on your behalf based on the rules of the prospectus, which are the rules that the mutual fund is governed by. Um, Here we have, for example, like the Vanguard in institutional index fund, institutional shares. So there are a lot of different mutual fund products. Some are actively versus passively managed. Passively means that the index that governs the performance of the mutual fund is exactly what the mutual fund is comprised of, that the manager does not take positions, which means buy things that are not in the index. A lot of Vanguard mutual funds are indexed and they are passively managed. All mutual funds have an index to them, but a lot of the Vanguard mutual funds are passively and not actively managed. So Google Finance might not be the best place to like learn about a lot of aspects of these different things that you might want to invest in, but this tool is really helpful. You can build a little hypothetical portfolio. You can even change what day did I buy Bitcoin? Like if I bought Bitcoin in like 2015, no, it's not letting me. It's not letting me change the purchase date here. I guess I would have to go in and create something else. So maybe I bought Bitcoin. I'll show you how I did it. So Bitcoin in dollars, and I want to purchase some Bitcoin, and I want to buy it as of Oh, it's only letting me buy it as of certain dates. And then it's telling me what the price is there. And then I can save it and I can add it into my portfolio. And then going forward, I'll be able to track like how is that portfolio doing? Like right now, it's worth $42,000. And then I'll be able to see, what it's worth as time progresses, right? So if I created this portfolio and I'm adding and subtracting things from it, I can get performance information. So it can let you test out your investment strategies, things you're interested in. I'm going to give you some basic information, gains, the companies that are in it, a little bit about the price to earnings ratios of those investments. And basically, when you add an investment, you have different options. So let's see, I can add stocks or ETFs. I can add an index, which you really need a mutual fund or an ETF to actively or actually invest in. So that's something to think about. But you can look up mutual funds and add them by their name or symbol. You can add currencies. And yeah, it's a pretty interesting tool. And your book talks about, just using like an Excel file. And I think that would be way more complicated than just like building a portfolio in Google Finance for hypothetical. And if you have actual investments like on a trading platform, they're going to have a tool for you to be able to see, what you bought, when you bought it, at what price you bought it, when you sold it, if you haven't sold it, what its price is. Okay, so little bit about the Google. Oh, you can create a watch list. So I just like made a watch list of like stocks I'm watching. So I have like a dashboard here and I can take a look at them anytime that I want. Like, how is Bitcoin doing? Oh, Bitcoin is really crazy. It's all over the place. Yeah. Oh, wow. Should have bought there, right? Okay. Or here. Anyways, other things I wanted to talk about. I wanted to talk about how to compute annualized returns from stock prices. So we think about returns on stock prices because if I have a share of Disney and it's worth $100 and then it goes to $200, I'm concerned about what that price appreciation looks like so I can compare it to other things. Like I might have a house that I own. At the same time, it's gone up $50,000 in value, not $100. But how do I compare those two items? How do I compare how much my house is appreciating versus how much a stock portfolio I have, and stocks of different values, some that pay dividends, some that don't? How do I compare their performance? So one basic way to do this is to just look at my returns on the stock over time, and then to look at my annual returns, because we're going to have volatility, right? We've got a lot of volatility in the stock market right now. So if I buy a stock, let's go back and let's go back and look at Disney. Okay, so I'm looking at Disney. And I bought a share of Disney in 1984 for $1, right? Like, and it goes to $34 14 years later. How do I compare that to some other stock that I bought it for $50 and it goes to $150? Well, I look at the percentage change in the price, which is the return. And if I look at it on an annualized basis, then I get a way to sort of smooth those returns over time. And where we have these peaks and valleys, I can see if I bought something in 1990 and I sold it in the year 2000, there's a lot of ups and downs. I don't want to know what the annual basis or the daily basis for, return for that stock is every day. I want to know roughly what am I getting every year for holding this stock. So let's say, for example, we want to look at the 5-year return for Walt Disney. Okay. In year one, so to begin with, March of 2017, it's worth $110. So I'm going to put that in my beginning price. And right now, it was doing a lot better. Everything was doing a lot better. November was really like when everything kind of took a turn for the worse. So right now, it's at 131.75. Okay. So over that time period, you can look at the formulas in here. End minus beginning over beginning is a basic rate change formula. So that's going to tell me what percentage my stock price appreciated or depreciated, increased or decreased, in percentage terms, so not just in dollar terms, right? Because again, dollars isn't helpful. If this was a house and it was like $100,000 and it went to $200,000, like that's a lot of money. But I had to pay $100,000 for it. So what is my return? Okay, so my return is 20% in this time period. Now, an even more interesting way of looking at it is not just looking at the average return, right? So the average return might be, okay, I've been holding this position for 5 years, and I have it for 5 years, and I get about, let's see what that is. Oops. $3.76% per year. What's wrong with taking an average return? There's nothing super wrong about it. It's a good way of looking at, in 5 years, we were basically flat to down for a year. Down. Then we were kind of up. Then we were up, right? So kind of up in March of 2019. Then we all know what happened here. We're kind of down again / flat. And we're kind of up, then we're way up, right? So every year we have, we're down, we're flat, we're way up, and then we're down. It's a lot of information. What happened in general over those 5 years? That's the average return. What happened on an annualized basis, removing the impact of compounding from our returns? We don't want to bias our returns with the impact of compounding. We want to say, if we were to happen to have purchased in 1 year, what would we hypothetically get? If we happen to purchase in another year, what do we hypothetically get? So annualization removes the impact from the compounding of our return. The formula is a little complicated, but I'm just going to leave it in here so that you have, and I'll put this one as average return, okay? So the average return is just going to be my return over the number of years that I'm holding the stock for divided by the number of years. My annualized return is my return over the time period raised to 1 over the number of years, or the root, right? It could be a square root if it was 2 years. It could be a cube root if it was 3 years. And it's the fifth root for 5 years. -1 brings it back down into percentage term. Okay? So I bought the stock in March of 2017. I sold the stock in March of 2022. And I got about 19%. On an annualized basis, which means per year, removing the impact of compounding, 1 plus the return over that time period raised to the fifth root -1 is going to give me 3.5% per year of a return. It allows me to compare apples to apples across the spectrum, okay? So we don't have 3-year returns here. And I can see, here's my 5-year return, right? Here's my 1-year return. So maybe I want to look up the 3-year return. Okay, so 3 years ago, what year were we in? 19, 20, 21, 22. So March of 19. Okay, how do I find that? March of 19. I can't really get exactly on the 9th, but I got the 8th. So 113.81. 113.81. Today, the stock price is 131.75. This is a 3-year return. So my 3-year return is looking better. Why is my 3-year return looking better on an annualized basis than my 5-year return, right? My 3-year return is looking better because March of 2019, the stock price was 113. It didn't do that much. Okay, so in 5 years, it didn't really do that much in the first couple of years, right? It did most of what it did in the last 3 years. So the first 2 years, 17, 18 to 19, it was kind of flat. So those years, the returns aren't really contributing to the stock price. There's not much price appreciation the first 2 years. But then the last 3 years, there's been a lot more stock price appreciation. There's even a really big dip in here. So even if we looked at the last 1 or 2 years, right? So the 1 year return, we're way down just because of what's happened recently. But if we looked at the returns over 2 years, we'd see probably an even better number. But then again, we have this part sort of dragging us down. So that's why you're going to see that the annualized return, or even the average return for 3 years, the average return is looking pretty good. Sorry, let's change this. Okay, and then the average return. Sorry, I need to put my formulas in there right. So my average return again is a little bit higher than that annualized return because we're taking out the impact of compounding. If you have any questions about this finance magic, please contact me. I will love to help you out. Okay, take care.